Hi guys, my name is EvolveHumans and welcome to my channel. So, have you ever thought about how rich people keep avoiding taxes? How they always seem to have more money left over, even though they spend so much? How they always seem to spend more money than the middle and the lower class and still have so much more money left over? How they seem to buy property after property and always have money left over because they seemingly never pay taxes? This video will be about legally avoiding tax on capital gains tax in the US, Brazil, and a little bit about England. Remember, it's legal. So let's get started. In Rich Dad Poor Dad, Robert Kiyosaki mentioned the deferred capital gains tax from the 1031 section of the Internal Revenue Code, the so-called 1031. What does this mean? Basically, if you buy a property for a certain price, and when you sell it, you buy another property for an equal or higher price, this difference in tax doesn't have to be paid under certain circumstances. Naturally, this got me interested. How can I avoid paying taxes? I started researching a lot. I went deep into research. So what did I find out? That if you don't use this Internal Revenue Code, you seem to be missing out. Let me use an example to explain this more simply. Kiyosaki, in his book, used an example of his friend. This friend was an average Joe, like you and me. He was saving money for his son's college fund. He was paying a little bit in every single month to a college fund so that in 12 or 15 years, his son could go to college and pay the exorbitant prices that college seemed to charge. He wanted to make money faster and make the college fund larger faster. And he asked Kiyosaki, his friend. Kiyosaki seemed to know what he was doing with money. So Kiyosaki and his friend searched around Phoenix, Arizona for cheap properties that he could buy. Now, luckily for them, there was a depressed housing market. It was in the lower part of the cycle, which basically means people are selling for much cheaper than they would on normal market value. We're on the upper end of the spectrum. They found a house at the asking price of $102,000, a 3-bedroom, 2-bathroom house. The owners were from California, and they had to get out and go back to California as fast as possible. So Robert Kiyosaki managed to negotiate a $79,000 asking price in cash. They accepted immediately. His friend put down a $7,900 down payment and got the house. And after mortgage and expenses, it turned out that he'd get $125 every single month from rent. That's pretty good. And after 12 to 15 years, the mortgage all paid down, he would get $800 every single month into his account, which was more than he was paying in for his son's college fund. And he had added benefit of having a property all paid down. 3 years passed and the housing market went up. Luckily for him, his property was now valued at $152,000, an $80,000 give or take increase. He asked Kiyosaki what he should do. Should he sell it? Of course, if he sold it, he'd have made an $80,000 profit and he'd be liable to capital gains taxes at about 15%. That would be $12,000 in tax, money given back to the government. Kiyosaki told him about the 1031. According to the 1031, if he traded in this property for a higher priced property, his $80,000 capital gains tax didn't have to be paid for. So that's what he did. He used the $80,000 as a down payment on a larger unit that would pay $1,000 every single month after expenses into his account, a tenfold increase. He did this again 3 years later because there was another surge in price, and now it turned out his property had made a $330,000 profit. What did he do? The 1031. He traded in the $330,000 profit as a down payment for a larger property that would pay him $3,000 every single month for rent. See what he did with $7,900? A little down payment went a long way. After 6 years, he was making more money than he ever thought possible into his son's college fund, and he had a huge property that he could sell off or keep for a rainy day. That's why a bit of financial intelligence goes a long way. So, you made it this far, that means you're interested. Let's get into the fine script. How is this 1031 viable? Basically, once you declare the sale, you have 45 days to declare a property that you will change it for. There are some other conditions, but basically you need to declare a property in 45 days. And then in 180 days, you have to finish the sale. You have to close the deal. Otherwise, it's void. You can also only trade the property for like-kind property. What does this mean? Like-kind is property for property. So a vacant land for a building for a residential, or a residential for vacant land, or anything that's basically considered property. You can't change a house for a painting. Not sure why you would, but you can't do that. Understand? The property must also be held for investment purposes only. So you basically can't use it as your main home or use it for any residential purposes at all, for yourself, of course. And this usually implies in about a 2-year minimum ownership, 2 to 3 years, it depends on where the source is. You must also factor in depreciation. Depreciation is a major source of cost change after you sell. It's basically the wear and tear of the use, and the curtain falls down and you chip the tiles, the painting comes off, the roof falls down, get a hole with the... You understand. It's whatever changes from mint condition. And this is a percentage of the cost of the building that's written off every single year for your tax filings. When you sell a property, capital gains taxes are calculated in a very specific way. They're calculated based on its net adjusted basis. The formula for net adjusted basis is property's original price plus capital improvements minus depreciation. What are capital improvements, you may ask? Capital improvements are all you do to make the property better, kind of like the opposite of depreciation. So you make a loft extension, you add in another wall, you put a new coat of paint, you make an office space, anything really, you make another garage, you rebuild the ceiling that was destroyed. You can add that to the property price, so you pay less taxes if you sell it. Let's use an example. You pay $100,000 for a property. You spend $20,000 to renovate it, and you sell it for $200,000. This difference of $80,000 is the capital gains tax, and you'll pay 15% of this instead of $100,000. That would be the original. All right, let's go to the next part. There is also something called boot, pronounced boot, spelled boot, B-O-O-T. It's a very important aspect, despite the name. And it's basically why you should use the 1031 to change a like-kind property for a property of equal or greater value. Basically, boot is everything that you sell that's lower than the original selling price. So for example, if you sold a $100,000 property for an $80,000 property, you'd have to pay tax on the $20,000 difference. Why not change it for a $120,000 property and you don't have to pay a tax on $20,000? Sounds good, doesn't it? And there's one final thing you can do to avoid taxes with this code, and that is die. Now, since no one's planning on dying, let's talk about inheritance. Basically, all this deferred tax that you make after buying property after property and adding on value, this gets wiped out, and the final price on your deathbed becomes the market asking price. So all this profit you made, you don't have to pay tax on. So that's good for inheritance. And that's why you should start early, because the more profit you make, the more tax you can defer. And deferring taxes is good. So how does this work in my home country, Brazil? In Brazil, there's a simplified and kind of worse version of the 1031. So there's a Lei 11.196, which is the Law 11.196, which basically says if you change a property for a property of equal or greater value, once every 5 years in your own name, you can defer the capital gains tax. What does that mean? You buy a 200,000 reais property, you sell it for 400,000 reais. Once every 5 years, you can exempt this $200,000 profit from the 15% sales tax, the capital gains tax you'll have to pay on it. There are some particularities though. It's much more restricted than the US. And I've studied this a lot because it applies to my situation. I have a few properties I've sold like this. Kind of like the 1031, you have 180 days to finalize the deal for the property and hand in the key. Otherwise, it's null. And you can only do it for residential properties. You can't do like kind. It's only residential property for another residential property. That's it. You are also allowed to use the condition to sell a property and not spend all the money to buy another property, but whatever profit you didn't spend will be taxed. Also, for the lower income bracket, anything up to 35,000 reais that's sold will never have capital gains tax. And if you sell one property every 5 years for 440,000 reais or less, you also don't pay capital gains tax. But you have to only have sold this property in the last 5 years. So let's try an example. You have a property that's worth 400,000 and the next 5 years it goes to 440,000. You'll have made a 40,000 reais profit. You have another property that's cost 400,000 reais and it goes to 500,000 reais. You've made 100,000 reais profit. Now, you could cash in the 40,000 reais and not pay any tax. Or you could sell the 500,000 reais property, roll it into another property of 600,000 or something, and this 100,000 will be deferred. Basically, it's put into your pocket without paying taxes. I much prefer 100,000 than 40. Simple maths. Now, I'd be remiss if I didn't mention the UK. The UK is a convoluted mess that I researched and couldn't find a satisfactory way to avoid capital gains tax on property. You basically have £12,300, which is this much in dollars today, every single year that say use it or lose it. Basically, if you don't defer these capital gains, you won't be able to roll them onto the next year. You have £12,300 per person every year. A couple has twice that, 24,600. And you avoid capital gains tax if you die, like the US. But then you have to pay inheritance tax. The UK has many rules, and on the 6th of April of this year, it changed to make it even harder to avoid capital gains tax. Now, if you want me to make a video specifically on the UK system, I have a bunch of research material that I read, and then I'll use examples to explain how it works in the UK. It's much harder than Brazil and the US, but it's good to know. So that'll be all for this video. Please leave a like and subscribe down below if you like my content. This really helps me to know if I can make more of the same content or if I have to alter my methods. This is a new channel, so I really appreciate all the feedback you can give me. Leave a comment down below if you like my content, have any questions, or if you want me to make a specific video about something you're interested in. I read and answer all the comments. Also a disclaimer, I made a challenge for myself. Pay attention. As soon as my channel gets monetized, from day 1 of monetization for a 30-day period, all the money I make from affiliate links, from backlinks, from Amazon sales, and YouTube AdSense will all be rolled into a fund I'll give to charity. I have a few things in mind. This will help me to give back to the people who gave so much to me, and I'll post a daily update on how much the cash pot is at the end of each video. So if you could help me with the channel by liking and subscribing, I would much appreciate it. See ya!